Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. What up, peeps? It is 1 o'clock on the East Coast. Just breaking over the last hour or so. Knicks going for it. Made a huge trade with the Pistons of Detroit, bringing back a guy that played for the Knicks a couple of years ago, bringing back a big man, giving up Grimes, couple people, draft pick, Fournier, get his $19 million contract out, expiring contract. Knicks are all in. I like what they're doing. By the way, the Rangers won last night in very workmanlike fashion. Tampa Bay, very good team. Rangers basically sort of made short work of them 3-1
Listen,
win.
and the listener and the viewer is going to get excited in the next few weeks. You're going to kind of morph into kind of a Yankee baseball sort of preseason sort of thing too. So we're going to have all of that going on.
Which much to Amanda's chagrin.
This is
it's market call. It's 1 o'clock on the East Coast.
Yeah,
Carter Braxton Worth will be joining us.
He will. Just in
and
a few
if
minutes.
It's Thursday, it's
Butters.
Bitch.
All right.
Yes, it is. So Butters is not here, but he's here.
Can you imagine? We're going to be down at
the
FactSet Focus.
Although
event
I should actually
down in Miami. They have not had one since before the pandemic.
18 or 19.
And they're going to have a lot of people down there, a lot of users. And you and I are going to be up there. We're going to be up on the stage. We're going to be doing a bunch of stuff. We're going to be doing market call live from there for a couple of days. Liz Young's going to be joining us.
Elizabeth Young here.
And Butters' name's just going to come up.
100%.
I mean, he's going to be on with us. And I think a lot of those folks, they're going to be waiting for it.
Can I tell you something? I'm going to feel out the crowd.
Yeah.
Because if I feel that crowd is up for it, I'll drop a Butters, bitch.
Well, let's see. Maybe we have to clear it with our folks there.
You got to feel the room.
All right.
Let's take a look at the rundown. I mean, this is like a very networky thing. Amanda loves stuff like this. S&P 5,000 watch, because
why not?
Why not? I mean, it got there yesterday.
Just so you know, we just got off our fast money call at 12:30, and there was a 5,000 watch call, by the way. So.
Strong arm earnings.
Yeah, that's good. I see what she did there.
So when they went public, we had Rick Heitzman on Fast Money.
Yeah, we did.
And I asked Rick about, in terms of valuation, I think in terms of basically sales to where it was,
every metric,
like 20-something times sales. I said he was not at all daunted by that. So Rick was spot on as usual.
Yeah.
And the sickest stat ever.
Ooh, you know where that's coming from?
That's the Edmonton Oilers, who just rattled off 16 games in a row.
It's coming from Doug Cass over there at Seabreeze, who writes for
Doug
Real
Cass
Money.
Watches every day.
He sent us this. I actually almost fell out of my chair, guy.
Well, it's good. I think it is. It is pretty incroyable, as the French say.
En français, s'il vous plaît.
We have a little tweet from this guy.
All right. Well, here's the thing.
Oh, you don't want to look at it?
I don't know this, Jason.
Here's the thing. What he does.
I don't know what he does, but I like his tweets. We've actually had 3 of his tweets on Market Call. This is Jason Goatfert. Goatfert. Look at this stat, guy. If the S&P closes above 49.58, which it has on Friday, or which it will, it's going
certainly
to match
seems
the
that
best
way.
15-week stretch in history for the S&P.
History is a long time. History is a long time. And, this actually speaks to we're going to talk about David Einhorn, I'm sure. But, one of the things that we've said for a while in the era of passive investing and all these quant funds and stuff, they basically, price discovery is no longer. I mean, passive investing is effectively sort of muddled up the works a little bit. And he's right. But you know what? If you're long stocks, it doesn't matter the reasons why. Here we are, Dan Nathan.
Yeah. And listen, it seems like there's a level of euphoria that's going on right now. Pull up an RL. This is a Ralph Lauren. This is a stock that was kind of stuck in the mud for a while here. It kind of worked its way back to a multi-year high. They report earnings and guidance, and the stock is not like a normal gap. This is just a blowout. I mean, we've seen this, again and again and again, and we'll get Carter's take on this, because he often, really, I think brings it down to a level that at least I can understand. If you're thinking about, how many of these stocks are making these sorts of moves in such a short period of time, there's only one way for them to go. And the best example of this, and maybe we could just pull up, not the chart that we made before, but just a live NVIDIA chart here going back a year, after that May gap, I mean, the stock consolidated between, $400 and $500. So it was underperforming, you know what I mean? The major indices and the SMH and all that sort of stuff. And it wasn't until this recent move where it really started helping out. And when it started to help out, it did so in a meaningful way. Whatever the S&P is up on the year, what is it? 3.5%? Or no, geez,
probably 5%.
It's close to 5% right now.
Yeah.
That's a good chunk of it there, guy.
100%. And it's interesting. You say only one place to go when you have a gap. And as you're pointing out, we had the same exact gap back in May of last year in NVIDIA.
Yeah.
When you could have said, well, I mean, that's the gap, it has no place to go but down, and it's only.
But that's the point,
up.
though.
Yeah.
But it did consolidate for
a
6
while.
months. Well, that's the
Absolutely.
point. I mean, like, to me, and an RL, that market cap doesn't really matter in the grand scheme of things. But we'll hit Carter on that. Well, why don't we do it? Why don't we just bring Carter Braxton
Is he in the wings
of Worth
I bet
charting
he has
here?
a tie on.
In the wings, men.
What's up,
How are you?
Talk a little bit about all right. So you look at, on a weekly basis, thousands of charts, right?
That's the idea. Try to cover as much ground as possible because most of the ground is not fertile, boring.
Yeah.
Pair of twos, no change.
But give us a sense, and this could be totally anecdotally, okay? It could be qualitatively, like the RL gap that we just showed you, right? Like are you being like a little inundated by those sorts of moves right now? And like the snaps on the flip side of that, which was down 35% yesterday, that's kind of few and far between. Are you seeing a lot of these in your work right now?
Yeah, I mean, and it happens every quarter. The truth is there's no higher frequency this quarter than any quarter. You're always, I mean, if we pulled up an APD, for instance, let's do that chart, air products and chemicals, a major, okay, you get a gap and drop, you get one like in Snap. So what it speaks to this, because this is the main thing, it's the futility of determining what something is worth. So the only way you get a gap like this outside of, we're restating our accounting, we've been cooking the books, or the chairman's been indicted, okay, we know what that kind of, or FDA approval for a drug, everyone's living instead of dying. Those are obviously gaps that are based on something. But when it's simply an earnings, every 90 days you report your results and the stock drops and gaps 10, 15, 20%, or surges 10, 15, 20% like ARM, what does that mean? It means that the result was so much better or so much worse than very smart people could figure out. So the average stock has about 20, average S&P stock, about 20 analysts covering it, 20. Yeah. So that means these aren't just people, as a hobby. These are people who are highly dedicated, highly educated. So that is to say they have degrees from prominent schools, typically in order to work at Goldman Sachs or Morgan Stanley or Deutsche Bank or Credit Suisse. And then what do they do with those degrees? They get certifications after the MBA. Then they get a CFA or a CMT or a CPA. Then they apply all that knowledge and they study a company like Ralph Lauren. That means you studied Coach and Urban Outfitters, and you studied Foot Locker. You studied the consumer trends, disposable income. You studied payrolls, and they collectively come to a conclusion about what the earnings will be, and it's hopeless. There's a reason I went to charts. I started as a fundamental analyst. It's not doable.
But here's the thing.
The point of a gap is you can only gap when the results are so far above or below what a lot of experts thought it was going to be.
But that's a great point. But here's the problem with ARM. They're not so far above. So that's the thing. And this is where I think some of that, guys, so I need your take on this, okay? Let's pull that ARM chart back up, okay? This stock in September of last year went public at $51, okay? The stock is trading up nearly $51 today, okay? So just do that math.
I can do that math.
$60 billion in market cap. And to your point about valuation back then, people thought it was a little nuts. All right, I just want to tell you about the beat. This is a note from Jeffrey's trading desk, okay? So it's up 60% in this guide. It said, a very strong print, but received pushback when ARM was up 40% at some point last evening. Okay. So the fiscal 3/4 licensing beat by 13% after management de-risked on the second quarter call. So that means they basically took down guidance on the last quarter. So they beat that lowered guidance. Okay. While the fiscal third quarter royalty revenues beat by 5%. ARM also boosted fiscal year guide to $3.16 billion to $3.21 billion. Let's call it 3.2, a 5% hike at the midpoint. Right. So like That is not an
Nothing.
eye-popping beat, guys. So it speaks to what I think is something really freaking weird going on in the market.
Well,
right
and
now.
then they gave 25 guidance where they said revenue is going to be about 3.9 billion, which is up, 24% year. Now, let's just break this down
Yeah.
first. So let's call it $4 billion. Okay.
Yeah.
This is a company that for the last 3 years prior did about anywhere from $3 to $3.2 billion a year. So pretty flat revenue, right? Right now, last I looked, I think this is $123 billion market cap. You can make it 120 divided by 4. You can start to do the math. I mean, it's an astronomical price to revenue. So but if that doesn't matter anymore, if none of this matters, as you say, have at it. But I am telling you, the growth to get to where it should be, call it 8 times revenue, maybe that's reasonable.
Yeah.
You tell me where it has to go.
For a semi stock too. Okay, this was going on
Anyway.
in our chat as we were trying to kind of build like the things that we're going to talk about. I pulled up an S&P chart. I put a little trend channel there. Maybe those our peeps can throw it up there. I've seen this on the social web here. This is one of the things giving some folks, kind of reason to continue to think that we can kind of push through 5,000. Carter, when you see that, you chose to look at some different time frames and some different lines. Let's look at the note that you just put out on Worth Charting. Just hit my inbox here. S&P sequencing here.
Sure. So if we look at the chart that's on the screen, what we're discussing, right, is what we're looking at, what your green channel annotates is the October to present advance, right? It's an advance. That's clear. Now let's put it in context in the market. So if we have our first chart of the S&P, so this is the S&P, its peak in the first days of 2022. We see the 27% sell-off to the lows of October of 2023. And then here we are now. So the first thing that my eye sees is the following, that these are we can flash that for fun. These are very distinct. That's what sequencing is all about. Those are very distinct intermediate advances. One's 20%, one's 21, one's 22, plus or minus. Let's also put in a channel. So the point is that we're at a level where it doesn't mean it's not a magic trick. It doesn't have to stop here, but it would be characterized as a mature intermediate advance. Let's put them together and then let's end it with some arrows. So does it have to stop at the red arrow? One could say that's all just nothing. Maybe the 5,000 was a magnet. People believe in that kind of thing, which is absurd. And it goes to 5,500. That's the next magnet. But what it gets down to for the great custodians of wealth, meaning mutual fund managers and pension plans and big endowments that are handling the life savings of many of Americans. Is this a time to be increasing exposure to equities as a general proposition, or to be pulling in one's horns? I think surely it's the latter. Not a popular view right now, but that's my thinking.
No, I'm with you, and I've been with you for a while, and each day it's seemingly, the level of frustration that I feel, given this sort of the levitation in the market on a daily basis, is extraordinary in a word. But, this chart speaks for itself. You didn't make up the lines, but something that has not participated comes in the form of the Russell. And Liz Ann Saunders, who was on our podcast, I don't know, 4 or 5 weeks ago, I lose track of time. She's pointing out the following. Guess what there, sports fans? The Russell's still in a bit of bear market here and has not participated at all in the broader market rally. And, again, if you believe, as I do, that these are the most economically sensitive names, understanding that small and mid-cap banks are a large portion of this, even with that said, I mean, there's no participation here, Dan.
Yeah, and it's interesting because where we're seeing just like levels of euphoria in all different sectors now, it seems to be spreading from the tech space, right? So we saw the gaps last week, in Meta and a few others. The week before was in Netflix, right? So now we're just kind of seeing it, like we just highlighted that RL. We saw, a few other things in the last week or so, but the KRE, the regional banks, they act poorly. We've been talking about that now, right? And so, you just made the connection between, the Russell 2000, small caps, and some of the regionals and the like. here. So, this is one where I guess you just got to keep an eye on. That was a chart that we used yesterday. And, it's broken that uptrend from the fall lows here. And let's see if this is going to be followed by some news. And I think, Carter, you're, you've been doing this a long time. You've been looking at gazillions of charts over your career. Usually when you have the sorts of breakdowns that like this looks like, if it was a single stock, you would expect some news to follow. Is that correct, sir?
Well, yeah, I mean, there's a couple of things in conflict here. We know that anything that makes a turn, as it did, a bearish to bullish reversal, that then checks back to the penny, to its rising 150-day moving average, is a sell-off to a level of support. That's the positive or constructive thing, where rebound potential is high. The negative, not depicted in this chart, is that it was on heavy volume in the KRE because of the NYCB drop and gap. My hunch is it stabilizes here. And in fact, what's interesting is I would sell volatility. No one will do that kind of thing. But to my eye, selling the 50 calls, only going out a week or two, is money good. The fact that this is going to bounce to 50 seems right. And everyone's position that it's about to plunge again. And I bet there's some really good premium in the 44s and that kind of thing. My sense is to strangle it here. And while fear is high, hopes are high, and watch the thing just decay.
Erode away. The bet here, obviously, if you're with Carter, is that not going to be any more tape bombs in terms of some of these. You got to think that the New York Community Bank, it's not necessarily a one-off, but it's a one-off for the foreseeable future. Let's call it 3 or 4 weeks. So, you sell that premium, it erodes to your favor, and you sort of come away unscathed. I do think there's more tape bombs to come in this sector. Where the question comes down to timing, Dan.
Yeah, and again, Carter has actually put a lot of thoughtful notes out over the last couple of weeks, following a lot of the earnings reports with some of these companies with those big gaps, and he's been talking about selling vol, whether you're long those stocks and looking for a way to kind of take in some premium post move. And really, what he's talking about is playing for consolidations, and if that's the sort of thing that floats your boat, it makes perfect sense. It's a good way to make money, even in a low vol environment. We spent a lot of time talking about a 13 VIX. A lot of these single names, you know what I mean, where expectations are really high and movement or expectation for movement is really high, it gives you some opportunities to take in some premium. Really quickly here, we detailed starting the week a collar trade idea, selling an out of the money call and using the proceeds to buy an out of the money put in NVIDIA if you're long, as a way to protect, but obviously leave some room to the upside. I think the stock was around 685, 690 when we detailed that a few days ago. Stock just hit $700. So closed yesterday at an all-time high. It's really doing its best to continue those gains. I mean, again, we'll continue to talk about it. $850 billion in market cap, nearly 1 trillion people since January 3rd or so. We don't have to get into much more of that, but this was the sickest stat ever that Doug Cass sent us. And I think he's using some data from Charlie Bolello guy, just really quickly. So NVIDIA versus the XLE, most insane stat in history. The schism between the markets haves, the Mag 7 and the have-nots, has likely been exaggerated by market structure as today. And we can talk a little bit about market structure, but you see the point here. It's all up there. You get the point. I mean, this NVIDIA is greater than the entire energy complex. And we know that Exxon and Chevron, which in probably not too many years past, maybe 20 years ago, Exxon was easily one of the top stocks in the entire stock market. When you see data like this, what does this make you think?
Well, people think there's this new paradigm, like there's this whole total addressable market you hear a lot about. And we're in this new age, and the semis has 3 to 5 years to run in the AI before it becomes a bubble. And maybe that's true. I don't know. But $1.7 trillion on, maybe they do next year close to 100 billion. You're talking about, again, 17 times revenue, which historically has been expensive. Now, people will say, Guy, they're growing into that valuation. Conversely, I've seen a lot of stuff about NVIDIA over the last week or so that I have not been able to sort of come to grips with. So I want to throw it out there. But there are a lot of people concerned about some of the groups that they sell into and some of the way things are accounted for. Yeah, I'll just put that out there.
We talked a bit about that on the show. There was a Sandeep Gupta. He's a credit analyst over at Barclays. He put a note out, said sell NVIDIA. We talked about it earlier in the week, so maybe we'll just kind of put that in the show notes too, to take another look at it. Carter, when you see this sort of data,
yeah, I mean, there's nothing wrong with that. I mean, look, these are. It's obviously great research. It's more sort of data mining, right? It's little bit of just fun facts, so to speak, meaning just to put this in context. So we know that the consumer staples sector is 6%, and we know that Microsoft is 6.6. So think about that. Microsoft itself is more than Procter & Gamble and Costco and Pepsi and Coke and Walmart and Philip Morris and Mondelez and Colgate and Target and Monster and Kimberly-Clark diapers and General Mills and Kraft. I mean, you can always find this kind of stuff. And I'm not saying it's bad or good. We are a very concentrated market. And one could say, yeah, and those big boring companies, including Walmart and Colgate and Philip Morris and Procter & Coke and diapers and ketchup, who cares? They're boring and Microsoft is worth more. But we know when we get this kind of phenomenon, whether it's that NVIDIA is worth more than the entire energy sector, or that Microsoft is worth more than the entire consumer staples, everything you see in the supermarket, it's the situation we're in. At some point, it gets corrected. It's not
well
corrected.
at some point. So Guy, but listen, we've all been doing this. I started in 1997. You started in 1987. Carter, you started around the same time.
Yeah.
As long as we've all been in the business, every period of euphoria that was based on some sort of secular shift, some sort of macro sort of combination of this and that, whether it was low rates plus this new technology, the convergence of cloud and mobile and blah, blah, they all like manifest themselves in the market at this moment. And sometimes they can go much longer than we all expect, right? But they all correct themselves. Like that's kind of the point. And so, like people look at us and say, a bunch of bears, this and that, whatever. But like, listen, if you want the cheerleader program, you know where to go. I mean, they're actually, they're predominantly, that's the programming as it relates to markets, as it relates to the economy, as it relates to the combination of the two. And I learned this really early in my career is that to understand like how a bullish trade will work, you better understand how the bear case of that situation works. So, like I think this exercise that we do every day, and we show up and we, admit when we're wrong and we're right plenty of time. I think it's a useful endeavor, but make no mistake about it. This AI thing will correct itself, at least in the markets. You know what I mean? As basically people get a better sense, they smooth out how it actually is going to work its way into different parts of the economy and how different companies are going to be able to monetize.
Well, that you just hit the nail on the head. How different companies will be able to monetize it. One, and then obviously with a great total addressable market, what happens historically? You get great competition. When you have great competition, regardless of what head start you seemingly have, prices start to come down. You have margin contraction. So, I mean, that's just the way cycles work. So we'll see. NVIDIA reports, I think, on the 21st. That'll be. I'm always excited.
We're gonna have to have a special programming that day. But can they pull up Google for 1 second? Because this is one I think it's worth talking about, Guy. Okay, so when we talk about how different companies are going to monetize these products after this extraordinary spend and the like. So this stock was trading at a new 52-week high. Okay, this is about 2 weeks ago, heading into its print. Okay, actually, I think it might have made a new matched high. Okay,
I think the prior high was in November of 2021, like 150-ish. Let's call it.
So the company disappoints and gaps down. Okay, and then it continues to go lower. But then when everything gets back on its horse, you know what I mean, because of the meta earnings and the like, this thing, catches a little steam, is starting to fill in the gap. This morning, they rebrand their Bard to Gemini. This is the competitor to ChatGPT. This is the thing that one of the reasons why this stock has massively underperformed, let's say, Microsoft and the like. But go back and look at 3.5 months ago. Remember that gap? They missed and guided down. But the stock went and made a new high and then it made a new all-time high.
Same thing.
So it's the same thing. But today, like people are like underwhelmed by that product that they just reintroduced, that they've actually now had 3 really bad intros of this large language model. So Guy, my point is like, this is just euphoria working its way into everything that actually is touching this sort of space. And we've been here before. We know how it ends.
What's funny is if you're not enthusiastic on your calls and, Google, you can make an argument that they have one of the biggest moats out there and they have one of the most reasonable valuations out there. But it clearly people want to be in those types of names. They want to be in names that you can get a 2 to 4% move seemingly on a daily basis. Google's not that name. Of course, when things do go pear-shaped, people are going to be running, I think,
Yeah.
for names like Google, which they can rationalize valuation.
So Carter, you don't care about the fundamentals as you call them. You look
Mhm.
at this thing, it's obviously been consolidating, fairly decent. You see your 150-day moving average. It served as some pretty decent support. If you don't care, let's say, about the fundamentals, it's cheap relative to this one, or this product cycle is going to be this versus that. What are those two gaps? The one from a week and a half ago and then the one from 3 months ago. What do they say to you? And I'm just curious how you're just eyeballing this chart right here.
Yeah, I mean, the key is you could feel that it's lost its torque, right? It's lackluster, and its relative performance is quite poor, not only to the S&P, but more importantly to the QQQ. And then you also have bearish price volume correlation, the dropping and gapping. It's not an exciting thing, and to be fair, it doesn't feel like it's going to roll hard and fall out of bed. This is also something that I would say goes into the pair of twos category, a very low odds hand of winning.
What has not been a pair of twos since last quarter has been Disney, which, maybe it was a king ace suited last quarter. And we actually talked about it on Fast Money. We thought, okay, you know what? That might have been it. You sort of matched the low from early October. It felt as if they got some of the things out of the way. And I thought it was setting itself up to go somewhere between 98 and 100. I didn't think it was going to 115, but here we are. You've been bullish as well. I think you want to remain bullish of Disney at these levels.
Yeah, I mean, now to be fair, this is a perfect instance where I would do what again. All my life, people said we do not sell naked premium, Carter. I understand that, but individuals can do whatever they want. There are individuals who made great fortunes in the .com and lost it. Some made great fortunes in .com and kept it. Mark Cuban. I mean, so you can do whatever you want. But in this instance, when something's pumped up like this, like I would sell premium. I would sell the 112s, the 115 calls. Now, the risk is people say, well, you're naked. What if it goes to 190? What if it gets bought out? Okay, let's eliminate that. It is not going to get bought out. Okay, so that's off the table. Now, one prefers to sell a credit, so we're maybe sell the 115s and then buy the 120s. I guess that's cautious, but I would sell naked something higher, 112, 114, you pick it, and then also you can sell the 105 puts. If this stock is going to drop and give that all back, what you're saying is that people put limit orders out, good till cans all the time. You're willing to buy the stock at 105 plus the premium you took in. Are you willing to buy the stock at 102? That's trading at 111. I would think so. That's the kind of thing I would do. But either way, it's a little overdone. If you're just a long only player, trim, reduce, take some measures.
Well, listen, and I think going forward, as we think about options here too, and we're going to be doing more of them with a partner, we're really going to be talking about options trading versus, let's say, long positions or versus short positions, and the shorting vol, whether you're doing it through strangles or straddles. There's other ways to do it where you're covered. There's a host of I listen, as long as I've been in the options game and speaking to retail about it. I started doing options action back in 2009. I just really want to be careful with the idea of naked calls and naked puts, because a lot of folks think that they have a handle on the sort of margin that they need to do that sort of thing. But it's like when you have that stock gapping up, and we are in a market where stocks are gapping up 20-30%, and they don't know what to do in those situations. You know what I'm saying? So I'm just really careful about it. I just want to make that point.
Yeah.
And so what I would say as an iteration of what Carter just said, if you're long Disney and the stock has gone from 90 to 115 and you still want to hold on to it, because this is one of those stocks that we've heard 1,000 times in our careers, I hold that for my grandkids. Well, then maybe sell some calls against it, take in that premium. It sets up a little buffer to the downside, right? You take in some, I just want to be clear, that's the way.
Sure. And also to add to what Dan's saying is, so again, just trim can. The only time we do this is when we have, would you sell a naked call on Ralph Lauren? No. Why? Get bought out, right? On a biotech stock? Never. Disney is not going to get bought out. You say, how do you know? Let's take that to Vegas and see what the odds makers say. The odds of it being bought out are very low. And the odds of it continuing higher when you're this far above the 150 moving average are low. But also that's the point why you're selling premium above at 114, 115. At that point, it would be farther above the 150-day moving average at any point in the past 5 years. You have to pick your stocks. They got to be large, never to be bought out. Yes, and then take your chances.
Yeah.
I'm sorry. I was going to say quickly, you brought some interesting charts on Nike, and These are going way back. So you obviously have a view here. So let's run through your Nike charts and view.
Yeah, I mean, okay, one of the great champions, literally, of all times. It came out at $25 a share back in 1980, and it split adjusted. That's about 15 cents. Take a look at, of course, this all data chart. Let's put a trend line in, an epic, and it's starting to break down. Does it mean it has to go lower? No, but let's put some more lines on. That's one way to draw them. If we zero in and look at this on a short term, it's a topping out formation, and then the short-term lines in the same chart. It's just it doesn't act well as the relative strength is poor. We can do another iteration, and then finally look at the relative performance. This is Nike's performance, making new 52-week lows day after day, week after week. Basically, the market has recovered substantially from its sell-off of 2022. Nike has not.
This is one of those names off cycle. I think they report like the middle of March or something. So you have a lot of time into earnings. Obviously, there's a huge China aspect to Nike as well. Valuation, it's been rich. It's been sort of market valuation. Right now, I would consider it sort of middle of the road. So it's not a valuation call. But to Carter's point, Dan, this is not traded particularly well for quite some time.
Yeah, it's really interesting to think about it on that long-term basis and then looking at the relative strength too, because again, you can look at a short-term chart, you can make whatever kind of decision that you want about the technicals and how it's acting relative to some of its peers. And some of its peers are acting pretty decently. If you look at like a Lulu and the like. So yeah, this one feels like a bit of a press, but by the same token, when this stock was at $90 and it had that big earnings gap, this is in late September.
Got up to 122, I think.
I mean, yeah. And why, so again, it looks like you had a little bounce off that $100 level. Maybe it sets up good as a little bit of a short, maybe it's put spreads or something like that. Let's look at this one, guy. I think it was on Tuesday. I think it was your final call on CNBC's Fast Money. It was WYNN Resorts. You said the stocks had a nice little run into the print.
I said they're probably going to fast fire me tomorrow.
No, but you said I think you stick with this one. I was paying attention there on that one.
Cheapest thing you can do.
So you're getting a little bit of a move here. It looks like obviously a lot of exposure over there in Macau.
Macau numbers weren't great actually, but you know what? It weren't as bad as people thought. I think that's exactly right. Yeah. And margins were better than expected. So that was a good sign. And it's still relatively cheap in terms of where it's been historically. I think for a while that it's had room. Look, I thought it could get back to sort of 115 or so, and that was the high I think we saw. I want to say in March of last year, and that's within a whisper of where we are. It's not whisker, it's whisper. So 115-ish. I think you pull the ripcord, but I still think you stay with WYNN here.
All right, Carter. So we could have drawn a downtrend line that's been in place on the 1 year, just gapped above that, right? But look at this chart going back, I think 7 or 8 years. This is a log chart. What does this say to you? Is this a spot where it could find some resistance?
Yeah, I mean, this is a case where I would look. It's a group thing, right? We know that LVS is also starting to turn and so forth. DraftKings. My hunch is to retain longs, but in a smaller spot. So I'd reduce longs, trimming, or in this instance, a perfect instance where I would sell calls, just the calls.
Yeah. All right. Couple things before we get out of here. I just want to hit another name that's actually not performing well. It's a name that we've talked about a little bit over the last month or so. There's a new CEO at PayPal. They had a bit of a product day a few weeks ago.
By the way, I mean, a week before they said, we're going to say shock and awe or something.
Yeah, it was their AI day. And it was
a Johnson move.
Yeah, it was a Johnson move. Didn't go over particularly well. And, the quarter that they just reported was fine. They guided down for the year. The guide wasn't disaster. I mean, this thing is probably sadly going back to 50. It's a cheap stock. They're going to probably have a new CEO in the not so distant future if this continues this way. But I just wanted to highlight that one because here's one that, this stock is down 80% from its 2021 highs. It's cheap. It's not growing particularly fast by any means, but at some point this year, I think the expectations are going to come down low enough and it probably fits into kind of a value fintech area, but it's not there yet. All right, last one before we get out of here. I don't know if you guys know this. I mean, Guy is, before we get out of the earnings segment, we do have a very important.
Yeah, well, you know it.
Yeah, I know. We wanted to get Carter's take on Pinterest because not only is Guy blowing up on the Insta, he's Guy.Adami.
I was early adapter in Pinterest, by the way.
Yeah, you adapt or adopter? It's like the
Adopter,
adopter. So this is back in November of 2013. Twitter had just gone public. You just mentioned our friend Rick Heitzman from First Mark Capital, who's a VC, is an early stage tech investor, and he came on the show. I think you and I both met him that day for the first time. And the question that Mel asked him is, what is the next internet stock to go public? It was Pinterest. And, you know, the crack staff, as you call them up at EC, that would be Englewood Cliffs, they made Guy a Pinterest page. It's still out there. The pictures are that old, 11 years.
It's maybe a man can find them. I don't know if Amanda can find it. Guy Adami Pinterest.
But let's talk about this, because this is one where, you know, listen, there's been a couple of decent quarters in a row. We know this is predominantly ad supported. You know, we saw two very different reports, one from Meta, one from Snap over the last week or so. The stocks had this big rally. The implied move is 13.5% or so in either direction. Carter, when you just think about, you know, the movement that we've seen in some of these ad supported names, some of the commentary that we've seen from some digital ad in the space talking about the war and how it's weighing on some consumer behavior and ads. Like, you look at this sort of move and you look at that implied move. Okay. What do you say here? We're not actually, I'm just curious. Like, when you look at this, there's a 1 year, maybe they'll flash up a 5 year too for you.
Yeah. The 5 year is the key, right? So it's always looking at one time frame, looking at other times to put in context a current price. So an extent, it's a double, right? Everything's up since the October low. We know this, right? The regional bank up 45% until this recent dip. Home builders up 40. So there you have it. It's like where you start your narrative, where the meter starts. Looking at this, you'd say extended. Hell, it is. It's got so much headroom, room to run. So it's a little bit of both, and it's knowing who you are in the market, what your time frames are, and what your objectives are. There's every possibility that this has a lot of room to run, all in the context of something that's just doubled in a matter of 14 weeks and is overdone. And there is no answer to that. My hunch is to be long, but be in a small long position, not a large long position.
I'm going over my Pinterest page now. It's unbelievable. I mean, not that anybody particularly cares, but I got Zach Posen stuff up there. I got there you go.
There it is.
That's just you. Yeah. Thank you, Amanda.
Look at that. Look at this guy. Oh, let's double click on that one. Guy was an Iron Man. If you guys don't know that, he ran hours a full
19 minutes.
All right, but let's go back to this. So this is one thing that's really interesting.
It's
a great page, and we'll put it in the show notes there. So this is a company that has 78% gross margins. Earnings are only expected to grow low teens this current year, high teens on sales. They got a good chunk of cash there. So it's got a $27 billion market cap, $2.3 billion in cash, basically no debt. Okay. So you look at this and you look at some of the results that we've seen, and who knows what they've been doing as far as AI. This is something where AI, generative AI in general, could be very helpful when you think about what people are doing on this platform. This is one when the stock was very near those lows. I think, Guy, you and I bandied about, I know I've done it on OK Computer with Rick, who's still a shareholder, but I've done it with you on the pod. This is one that's like a layup. And I know where you're going to go with this. We were just talking about PayPal as an acquisition target. And it's probably like a Walmart who wants to better compete, right, in e-commerce with, let's say, an Amazon. Well, to have this sort of footprint across the web and have a platform like this where people are pinning things and then go to commerce and then go to payments and all this sort of stuff, does that make sense to you?
$40 billion deal makes a lot of sense. And listen, ever since there was an activist got involved, I can't think off the top of my head, but I want to say it was late 22, and we talked about it. Activist gets involved. The stock makes sense on valuation. I think it still does. It was Elliott, right?
Yeah.
And here we are. So in the earnings, these things are complete crapshoot. You saw what happened with Snap. I mean, could it happen with Pinterest? I guess. But this is one you want to keep an eye on.
And the hard part about kind of defining your risk using options is, like, just to give you a sense, we talked about a 14% implied move. Okay, so today's Thursday, so Feb 9 expiration. That is tomorrow. The stock, let's call it 40.5. The 40.5 put is offered at $3.20. Okay, so that's about 8% of the stock price. The 40.5 call is offered at about $3. Okay, from where it is right now. So if you were just gonna, and I know what Carter's saying, sell the straddle, right? Take in $6, $7 or whatever, because the likelihood of it moving over 14% or so is not particularly great. Again, this is a company that could get bought out. You don't want to be short naked calls. The same point I would make is, let's say the 40.5 put, say you sell that at $3.10. Well, what if it has a down 30% move like Snap just did, which had a very similar market cap, just a week ago. So that's one of the things about idiosyncratic risk and selling naked calls or puts and names. And Carter, you said it, know the names. You know what I mean?
It's got to be Disney. It's got to be NVIDIA. Can NVIDIA be bought out? I mean, people say never, 100%. I can guarantee 100% odds it can't be bought out. Who the hell's going to buy it, right?
God is
Berkshire,
going to buy it. God has
right?
anointed
The
it.
Federal Reserve could buy it. But I mean,
Right.
when you do a JP Morgan, who's buying JP Morgan? That's why we did a strangle on JP Morgan. Who's going to buy JP Morgan?
Yeah.
Who's going to buy this? So forth
Should-
and so on, right? But
Should
yeah,
Doug
this is
stick
dangerous.
around for Butters?
Yeah. Why
Okay, set it up.
If he doesn't mind this, here's the deal. And you already previewed it. But
Yeah.
this is Market Call. It's Thursday. We get a preview of FactSet's earnings insight blog that drops every Friday morning. You can have it in your inbox. It's from John Butters. It's at insight.factset.com/subscribe. But again, we get a preview here, guy. And I think this is some really interesting data here. As we get to the tag ends of Q4 earnings season, a lot of analysts, have, kind of jiggered their estimates, at least for the current quarter and possibly for the full year. Butters has got some data here for us. All right. He's saying the forward 12-month PE ratio for the S&P 500 recently surpassed 20 for the first time in nearly 2 years at 20.1. On February 6th, the PE ratio was above the 5-year average, 18.9, the 10-year average, 17.7, the 15-year average at 16.1, and the 20-year average at 15.6, and the 25-year average at 16.4. Now, here's one point I just want to make. Those averages, for the most part, at least the ones over the last 10 years, interest rates were much lower. So when you think about where interest rates are right now, and you think of this PE at 20, it's also saying something, guys.
Well, Jerome Powell, when asked about valuations when interest rates were zero, and I'm paraphrasing, but it's something akin of, in a zero interest rate environment, valuations don't matter all that much, which is why the 5 and the 10-year are as elevated as they are. But even with that, and let's just call the average 16.5, 17. Now you can start doing the math. The market is still overpriced in this environment with higher interest rates. So it's just, again, you don't trade on PE alone. It's just one input for sure. If you try to short things because they seemed expensive in terms of valuation, that's not a good recipe. That's not a good strategy. With that said, I think you have to be aware of what's going on out there.
Yeah. So Carter, when you think of this, and I know on Worth Charting on Fridays, you've been doing this Factor Fridays, which has actually been a great, the whole different sets of factors that you're looking at and how to think about them in the broader context of investing and trading and the like here. When you think about this sort of data set, how important is this to you just to be aware of this? Because also with 20 times earnings at this point, I think a lot of folks are pricing in the potential for cuts this year. We know the CME Fed Funds tracker is pricing in, obviously, that cut, a good chance of that coming in May, or the first cut in many years of the Fed Funds rate.
Right. So the key, remember, they're just coming out from two ways. This is a bottoms up approach, which is this is from analysts who are men and women responsible for knowing a small subset of companies, typically 15 to 20 in a coverage list, maybe more, and then determining two things which are very hard: interest rates, looking out, and then earnings on a forward basis, and then putting a discount to those future earnings. And I will say that if you then take the bottom approach, you get an S&P sort of a PE. But remember, earnings on average going back the past 7 years have been revised down typically 1% a month. So that in the beginning of every year, when you have so much room to run, you put out very sort of rosy or optimistic or just hopeful or genuinely, upbeat estimates for most companies. And then over time, analysts start to ratchet those numbers down. Now, there are exceptions. Tesla is being ratcheted up, of course. But the forward P is based on two things that are moving: the earnings, which typically is revised down, and then the interest rate, where you assign multiples, is very hard to guess. But what we do know is that based on all things, if you say ceteris paribus, all things held equal, the market is not cheap. Could it get more expensive? Sure, but it's not cheap.
Yeah, and we spent some time on Butters data last week talking about just the technology sectors, their contribution to the earnings growth that we've seen in the last couple quarters here. And I obviously this next slide kind of highlights this. 8 of the 11 sectors had higher PE ratios on February 6th compared to their 25-year averages, led by technology. The energy and utility sectors, Guy, were the only two sectors with PE ratios below their 25-year average on Feb 6th.
Real estate's the one that probably doesn't have the data to back it up. With that said, I think if you were bullish, or if you are bullish, you'd feel a lot more comfortable if you didn't see the two things driving the market, which is the first ones, technology and consumer discretionary, the things that are driving the market being the most expensive vis-a-vis their average. That has, again, it should be somewhat concerning, especially if things are mean reverting. So it makes sense, energy, it makes sense, I guess, to a certain extent, utilities, financials are sort of nowhere. People want the beta, and that's what you're saying.
And the last thing I just want to say about technology is that, we're seeing job cuts in lots of different spots here. And this is something that very reminiscent of what we saw in 2022, as a lot of the tech companies were seeing sales drop off, right? And so they were looking to cut costs. And then we had that inflationary period where, when they're trying to pass through higher input costs, they needed to cut costs. At some point, when they're done cutting costs via head count, okay, again, this year, we might see R&D, we might see enterprise spending go down. And that's how that energy sector starts to decelerate, at least, and then maybe decline year over year, because there's going to be some tough comps. And when you start seeing the tech earnings contribution trail off, and we don't see an inflection in the economy, and I don't know how you could without that, that's when you see a correction in these valuations in these stocks. So that's my 2 cents there. But we'll get
that's a great listen. The graphics, we can talk about it all you want. When you see it visually like that, I think it speaks volumes. So
check out John Butter's Earnings Insight blog. You can have it to your inbox. You know where to get it.
Why wouldn't you?
Right there. Check it out. We always get a preview on Thursdays. All right, that's it, Guy. I think we covered a lot of ground. Show.
Carter Worth, you are the man as always.
Thanks, guys.
You look great, handsome.
To be honest,
handsome,
very handsome.
I mean, the only thing that surpasses your good looks is your intelligence
and his intellect. Right?
What's the expression? Flattery will get you nowhere.
Well, in this
thank
case,
you for it.
All
the love
out of the show. I want to thank FactSet, Butters. If it's Thursday, I'm going to just say it. Go ahead, Dan.
If it's Thursday, it's Butters.
Bitch. Yes, it is. I love doing that. By the way, I might drop that in.
We might. We have to see. We have some people that we have to talk to about before we do.
By the way, you Met fans out there, and then where the show's ended, it's crystal freaking clear that they don't want Pete Alonso on that team for whatever reason. So enjoy it while it lasts, because he's going to be in a Cub uniform before you know it. But that's it. We won't see you tomorrow, because tomorrow's Friday. Although in the near future, we'll probably be doing these on Fridays. So take a look. And check out all our different social media platforms. You can put that slide up, because we're all over the frickin' place.
Blowing up. So every morning we're doing a little bit of a preview of what we're going to be talking about on the market call. So that's Guy.Adami on the Insta, Risk Reversal Media on the Insta. I'm Dan's Nathan, Dan S. Nathan. So follow us. We're trying to put some good little clips on there. We're going to actually take some of those clips and we're going to expand on them, Guy. We're going to double click on them. Is that something that
people do that? Yeah. Also, our YouTube channel. Subscribe to it's doing really well. Subscribe to YouTube.
Check it out.
Why wouldn't you?
Yeah.
It doesn't cost you anything.
Nothing.